what's your take on the direction of duration? Because there's a lot of contentious chatter out there right now. Is there no way that we don't see a 5-handle sooner rather than later?
Yeah, I think there's no way. It looks like we're really in a technical momentum trade here for the 10-year to reach that level. Because what happened last week, was that on Thursday we hit that 468 and change high on that day when jobless claims were low, and actually some other data was stronger, and that kind of drove up the yield. Then the following day you get inflation, and that led to somewhat of a rally because that was good data for bonds. So, core inflation further moderating. So we went from 468 to 452 and change, but we held support there at that 4.5 area, and that's key because that's been actually viewed as initially as a resistance point. So we broke through it and make it a support, and you're now in this technical lurch higher. And again, we had stronger data today, both manufacturing PMI as well as the ISM data was better, with new orders better, employment better, and then you do get a treasury market that pays really attention to it, especially on a day when we have no shutdown of the government, which then also means there's no change in any kind of fiscal spending, and then the economy is projected to stay strong, and that's reflected in the yield.
That's getting reflected in the yield. But I do want to get your sense, Ben, on what people are saying about if rates stay higher for longer, what that means for the underlying economic condition going into 2024. Because politically speaking, the government right now at the center, which is led by the Democrats, would want to win on the economy to showcase before elections.
There's no question, and I think that we're now learning as investors that higher for longer is a different idea than pre-financial crisis or even pre-pandemic, where you had periods of time that the Fed policy was on hold. At a certain level, right? And then it eventually led to rate cuts. And we're now maybe making an assessment that we have to stay on hold on that high level because we have inflation that just isn't cooling enough fast enough. And that's really key for the performance of the economy. If we're not getting cooler inflation, then that could restrain activity. But I do think, though, in a presidential election year, where there's sort of showing now through the political process that this shutdown that was sort of kicked down to the can, as they say, to November 17th, won't matter too much for bond markets because no one in a presidential election year wants to own a shutdown or any kind of disruption of fiscal policy because that's going to hurt the economy, just like you said. So as that's the case, fiscal policy has a huge effect on economic activity in the United States currently, particularly in manufacturing, because we really are pushing hundreds of billions of dollars into investment. So as long as that's the case, the economy stays, I think, very vibrant, and therefore the higher for longer may not necessarily hurt the economy as much. It just keeps it in a restraint. So it can accelerate maybe further, but it would certainly not lead to a recession. So I'm more on the optimistic side that the economy stays stronger into next year as long as fiscal policy can continue where it is.